You know that moment when you found the perfect opportunity to level up your business, but your bank account is saying, not today? Maybe it's that ideal storefront or a game-changing piece of equipment or bulk inventory at prices you'd be crazy to pass up. I've been there myself, and I've seen the same story play out with businesses in every industry and market I've worked with. Trust me, that feeling when you watch competitors grow while you feel stuck is beyond frustrating. But here's what I discovered after working with hundreds of businesses. This isn't a money problem, it's a strategy problem. I've seen that successful businesses aren't the ones with the most capital, they're the ones who know how to leverage the right financing at the right time. The solution isn't working harder or waiting for some magical windfall. It's having a smart capital strategy that turns your ideas into reality without keeping you up all night. The right funding approach can be the difference between staying stuck and breaking through to that next level of growth. Let's be real, funding options are a maze. Between SBA loans, term loans, lines of credit, and equipment financing, it feels like you need a finance degree just to get started. And even with my business background, I can tell you it's very confusing, even with the credentials. But after helping businesses from startups to 8-figure companies, I've learned something crucial. Different funding options are like different tools. You wouldn't use a hammer to tighten a screw, right? Let me break this down a little more simply. SBA loans give you the lowest rates with longer terms. Perfect when you're making big moves like opening a new location. Business lines of credit are like your chill friend, only paying for what you use when you need it. And equipment financing uses the equipment itself as collateral, which can work beautifully even if your credit history has some bumps. I've seen this firsthand across different markets. What works for a boutique might be different from what's right for a manufacturing business. The key is matching your specific situation with the right funding solution that aligns with your business goals. I can see it on your face during consultations, that worry that you won't qualify. Maybe your credit took a hit during the pandemic, or your business is relatively new, or last year's numbers weren't Instagram worthy. Every time you think about applying, there's that little fear of rejection that someone's going to judge your whole business journey based on credit score. But having worked with lenders across multiple markets, here's what I know for certain. Lending standards have evolved. The days of perfect credit, decades in business, and flawless financial history being required, they're gone. The landscape has changed, especially after everything that's happened since 2020. What actually matters now, stability over flashy growth, manageable debt levels, and having a clear plan for how you'll use the fund. I've seen businesses get approved after being turned down multiple times simply because they finally presented their case effectively. It's about positioning your business in a way that highlights your strengths and addresses potential concerns upfront. It's telling your business's story the right way through both numbers and narrative. Now, can we talk about the voice in your head, the one that says real entrepreneurs bootstrap or taking on debt means you're failing? I hear from clients all the time, especially those who grew up with families with traditional views about borrowing. But here's what my business background has taught me. There's consumer debt, and then there's strategic growth capital. They're completely different animals. One is buying things you can't afford, and the other is investing in things that make you more money. The mindset shift comes when you start running the actual numbers. If a $50,000 loan costs you $5,000 in interest, but generates $20,000 in additional profit, that's not debt. That's smart business. It's like hiring an employee who triples their salary and revenue. I've watched businesses transform by using capital strategically, locking in bulk inventory discounts that instantly boost margins, investing in systems that reduce labor costs, or expanding to locations that increase revenue while spreading fixed costs. These moves don't weaken your business, they strengthen it. You've hustled, you've pivoted, you've weathered storms that would have sunk other businesses. The passion and the grit it takes to build something from scratch, I see it, I respect it deeply. But reaching that next level, the one that you've been visualizing, often requires a strategic partner who understands both the numbers and the journey. Here's your straightforward path. First, get clear on exactly what growth opportunity you want to pursue. Second, understand which funding option aligns with that specific goal. And third, prepare your case in a way that tells your business's story effectively. Because yes, the numbers matter, but so does the narrative. The businesses that thrive aren't waiting for the perfect time. They're making strategic moves now. Don't let another opportunity slip through your fingers. The right funding strategy could be the key that unlocks your business's next chapter of growth.